Most people think investing is about making money. It's not. It's about buying time. That's the first thing almost nobody tells you. When people say they want to be rich, what they usually mean is they want freedom, options, control, margin, peace. And investing is one of the only systems ever created that allows your money to work while you do something else. Not harder, not faster, elsewhere. That's why people who understand investing early live in a completely different reality later. And here's the uncomfortable part. If all you ever do is trade time for money, you will almost always be fighting gravity. Because expenses compound too. Inflation compounds too. Missed years compound too. So the real beginner question is not, what stock should I buy? The real question is, how do I start owning things that can grow without my direct labor? That is investing. What investing actually is. Investing is not gambling. It is not prediction. It is not excitement. Investing is the act of putting capital into an asset that has a reasonable probability of producing more value over time. In simpler terms, you stop being only a worker and you start becoming an owner. That ownership can look different. A stock means you own a piece of a business. Real estate means you own a productive asset tied to land, rent, and long-term demand. Bonds mean you are effectively lending money for a return. Even a simple index fund is still ownership, just diversified ownership. That's the mindset shift beginners need to make. Don't ask, what's going up next week? Ask, what am I buying? Why does it create value? And why should that value be higher over time? That one question eliminates a shocking amount of bad decisions because once you understand investing as ownership, you stop behaving like a spectator and start behaving like an allocator of capital. And that is a very different game. Step 1, build the right mindset before you buy anything. Before your first investment, understand this. The goal is not to look smart. The goal is not to be exciting. The goal is to build a machine. A machine that takes a portion of your income, deploys it into assets, repeats the process, and compounds quietly for years. That sounds boring? Good. Because boring is often where the money is. Beginners get hurt because they think investing should feel dramatic. They want the adrenaline of this could 10 times. They confuse intensity with intelligence. But the best investing decisions often feel almost disappointingly rational, clear, unemotional, repeatable. So step 1 is simple. Decide that you are no longer trying to win the week. You are trying to win the decade. That one decision already puts you ahead of most people. Step 2, understand the main asset types. Next, understand what you can actually invest in. You do not need to master everything. You need to know enough to avoid confusion. First, stocks. These are shares of companies. If the business grows profits, cash flow, and market value over time, your ownership can become more valuable. Second, index funds or ETFs. For most beginners, this is one of the smartest starting points. Why? Because instead of trying to guess which single company will win, you buy a basket. You reduce the risk of being wrong about one business. Third, real estate. This can create wealth through appreciation, rental income, and leverage. But it usually requires more capital, more management, and more complexity. Fourth, bonds or cash-like assets. These are generally less exciting, often lower return, but useful for stability, liquidity, and balance. Here's the mistake beginners make. They think complexity is sophistication. It isn't. Sometimes the smartest portfolio is not the most complicated one. It's the one you actually understand well enough to hold through pressure. And pressure will come. That part matters more than people think. Step 3, make your first investment. Now let's make this practical. If you're a beginner, the process is surprisingly simple. Open a brokerage account with a reputable platform. Link your bank account. Decide how much you can invest consistently each month, not once, monthly. Then choose a strategy simple enough that you can stick to it. For many beginners, that means starting with a broad index fund or ETF and investing on a schedule. Not because it's flashy, because it's effective. This is where people get disappointed. They expect the first investment to feel like a breakthrough moment. Usually it doesn't. It feels small. That's normal. Because wealth rarely begins with a dramatic leap. It begins with a repeated decision, and repeated decisions are powerful because they remove negotiation. You stop asking yourself every month whether you feel like investing. You automate the behavior. And once behavior becomes automatic, results become far more likely. This is where compounding begins, not just in money, but in identity. You stop being someone who wants to invest, you become someone who does. Step 4, understand compounding correctly. Most people hear the word compounding and think it just means growth. That's not precise enough. Compounding is growth building on previous growth. It is momentum with memory. And this is why time matters so much. A person who starts earlier with small amounts often beats the person who starts later with bigger amounts. Not because they are smarter, but because they gave the system more time to work. This is one of the most misunderstood truths in finance. The first years matter more than they look, and the last years pay more than they seem fair. That's why waiting for the perfect time is usually a very expensive habit. People lose years trying to optimize their entry point, when the real advantage was simply being in the game. Perfect timing is seductive because it flatters the ego. Consistency is powerful because it builds wealth. Those are not the same thing. Common mistakes beginners make. Now let's talk about where people get trapped. First, they chase hype. They hear about an asset only after it has already exploded, then they buy excitement instead of value. Second, they confuse risk with volatility. Something moving up and down is not automatically dangerous, and something stable looking is not automatically safe. Real risk is often not understanding what you own. Third, they try to get rich fast. That mindset destroys judgment. It makes people vulnerable to stories, personalities, and urgency. Fourth, they let emotion run the portfolio. They buy when they feel optimistic. They sell when they feel fear. In other words, they use emotion as an investment strategy and then wonder why the results are irrational. Fifth, they outsource their thinking to loud people. A confident voice is not the same as a credible process. That's a dangerous confusion. Because many people giving investment advice are not teaching discipline. They're selling stimulation, and stimulation is addictive. But addiction is not a wealth strategy. What people don't usually say about investing. Here's the part people don't usually say clearly enough. The winning strategy often looks unimpressive while it's working. That's why so many people abandon it. A disciplined, boring, long-term strategy does not give you many stories to tell at dinner. It gives you something better: results. Also, many experts should not be trusted blindly. Not because all experts are wrong, but because incentives matter. Some people make more money talking about investing than actually investing well. Some are rewarded for attention, not accuracy. Some are selling certainty in a world where uncertainty is the price of admission. That should make you more thoughtful, not paranoid. Thoughtful. And here's another truth. The market does not pay you for being emotional. It does not pay you for being busy. It does not pay you for having opinions every day. It tends to reward patience, sound judgment, and the ability to remain rational when other people become reactive. Which means investing is not only a financial skill, it's a psychological skill, maybe even more than a financial one. So how do you start investing? You start by understanding that money sitting still is not neutral. You start by realizing ownership changes your future more than effort alone. You start by choosing simple, intelligent assets you understand. You start by investing consistently, not theatrically. And you start before you feel fully ready. Because the biggest cost for most people is not making a bad move. It's staying on the sidelines so long that time stops being an ally. Investing is not about proving you're brilliant, it's about building a system that works even when you're ordinary, busy, distracted, or unsure. That's the real power of it. You do not need to predict the future perfectly. You need to position yourself so that time can help you. And once you understand that, investing stops feeling like a finance topic. It starts feeling like a life decision. Because in the end, the smartest investment move is not finding the perfect asset. It's becoming the kind of person who understands that waiting has a price. And most people are paying it every day.